All right, good morning, everybody. It's kind of a light day today with the Econ. Not really a whole lot. We got CPI next week, so that's kind of the thing on deck. It's a quiet day. Let's see if it sticks. Kind of get into the weekend without too much drama. We do have some Fed speakers today, 12:30 and 4 o'clock. Kind of see how those play out. Otherwise, there's really not a whole lot on the table. So looking at what's going on, the Asian markets closed down on the day. Europe, remember yesterday morning when we were looking at them, they were breaking to the upside. By 10:30 when they closed, they had pulled back in again. And while they're still open right now, they are down on the day as well. We still got that move higher in crude and Brent, kind of coming up into that resistance level across the top of this zone. It's really it's kind of a moment in the sand, if you will. It needs to resolve this and make its way back down again, or we're actually going to see a breakout in energy. Be kind of nice to see that. So we're looking at same numbers as yesterday, WTI 82 and Brent crude 88. Just watch for, that front running. Looks like they anticipate a little bit out of Waller's speech today. To 12:30. We hit the edge of the weekly expected move, which is like 40.62 or something like that. Right on the edge, came up off of it a little bit this morning. It's worth keeping in mind where that level is. We tend to close inside the box 70% or better. So, more often than not, we close inside rather than outside. But in a bear market, we're in that other 30%. In that other 30%. See volumes a little heavy today compared to what we've seen recently, where we've been, starting the mornings at around 106 or even in less than 100. This morning, we're sitting in the 170s. So it certainly shows more participation this morning. And speaking of participation, the MOC numbers have just really continued to be slight and mixed without any real dominance on one side or the other. So it is interesting to see this level of volume this morning. It's not a concerning level at this point. Above 2 or maybe 2.25 would be concerning, but we haven't seen a number like that in a while. And it really highlights the activity this morning. It actually, I'm a little curious now. All right, so about 2:15 this morning is where it started to really pick up. So the European session. All right, we didn't get a move through the kill zone, but after the kill zone closed, got that move between, say, 3 and 4. We have a very narrow IB from the overnight hours. We are looking at an inside day breakout at this point after a really nice Busby maneuver. And so far, we have a consistent pattern unfolding. Market maker move at 0.6. Add that to the ADR at 1.6, and we end up with a 2.2. But, you know, if you look back and you think about it, how many times we moved more than 2%? We usually went to, 2.5 or 3. Still, we can game it out. 40.32 is the ADR. So from there, we could add the market maker move, which would be another 0.6. So just, kind of ballpark it using the drawing tool. That would get us right down to about 40.08. I got to argue, man, if you get 8 points away from the roundy, you're very likely just going to go to the roundy. All right. So and the same thing for the top side, 0.6, which lines us up with the 7th, the high of that day. That's pretty easy to remember, 41.88. All right, so we have an MDP. That's a missed daily pivot. We are inside day breakout, and we've already traveled half the ADR. We are very close to the weekly expected move at 40.62. Below that, we have the full ADR at 40.32, and then we have the market maker move added to this at 4,000. Now, there's not really a catalyst for a downside move at this point. It's sentiment based, kind of backing off of the market exuberance from misreading Powell and kind of coming out with that really risk on stance. after believing that his hawkish rhetoric was hot air. So now they're trying to reconfigure that a little bit. CPI is on deck next week, and it's going to be a really big deal. We're going to end up getting into this hurry up and wait scenario again. And I was talking with somebody yesterday who said he really felt like, and it wasn't getting any opportunity to trade because there was all of these things on deck, right? He had to wait for CPI, and then he had to wait for an earnings, or he had to wait for an FOMC, or it always seemed to be something else, you know, and then he just felt like really couldn't get some decent trades because of it. He's not wrong in the current conditions. It is like that, but we're not always such a hyper data driven market, right? A lot of times, if you were to go back, the Fed's not doing anything, right? And so everybody's not parsing out every tiny little Fed data point and then reacting to it. So it's not going to be like this forever. This is just the market that we're in right now. Everybody is parsing through the most minor bits of any data point that the Fed will use to make a decision on whether they are going to pause or not. That's just the worst of it. Right? So CPI next week, it's very likely into Monday and Tuesday that we kind of hold the line. So we're going to be opening down on the day, down, having a down week, but we're still inside of this previous week. And as we go into CPI next week, last week's candle is going to be the dominant candle. And that's your dominant range or your dominant zone. Beyond that, we're still in the shadow of this week right there. So that was a wild week. It's very, very likely that we're going to hold the range and not leg up and break out during until at least CPI. So it's something to consider, right? Are some trades that take advantage of this information. Tuesday, Valentine's Day, February the 14th at 8:30 in the morning, we're going to get CPI. So in neither one of the two dates you mentioned. But it's a good thing you asked, right? Because now you know. Yep. It's a pretty big week because we also have retail sales next week. And there's still a whole lot going on with housing, and that's next week. Next week, in fact, is a really big deal on housing. So CPI aside, even without CPI, that big housing data next week. Time zones are the worst. I get it 100%. Believe me, I get it. 10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We're working our way back down to those lows. Right now, 4,000 is the line in the sand on the lower edge. We made it through the air pocket of risk and getting into this collected junk. Not much lower, and we're going to start to fall into this shallow zone again. Starts to lighten up. There's really nothing in this trash to help us out. right? There's just really nothing here. We are below the point of control, and we are below that air pocket of risk. So one thing about that air pocket is if we do make a shot to the upside, we very likely could move back up through that area relatively easy. All we would have to do is get above 4,100. All right, we took out the VPOC that has been there for a while. Get rid of that. And we took out this VPOC. Get rid of that. It was a nice touch yesterday. It was this consolidation right in here. This is where we hit that VPOC, stabilized for at least a little bit, and then broke through it and went beyond it. We still have one overhead at 42.30. I'm sure that one's going to be there for a while. And we still have one down below, 39.88. We have an old CPI print coming up. I don't know the date on where this one came from, but I have a habit of marking open, high, low, close on CPI, PPI, and FOMC days, and then carrying them forward. You can see I keep it really light. I don't want it this bright, glaring line in my face all the time. It's subtle, you know, it's light enough you can almost see past it. The mark is 50% of that CPI day, and you know that alone tells me it was probably a pretty good sized day, because I have a habit of marking really big days in their center point. So that's at 40.56. We'll see how the market responds should we get down there. It's a really old line. Yeah, I mean, I've started to nibble around the edges in my longer term buy and hold portfolio. Mutual funds and, you know, a little bit of energy and some bonds. So, yeah, I mean, there's been some analysts saying that we could leg down and you know, pinch a low one more time, but that we very likely won't see, you know, like 3,200 or 2,800. So with that in mind, considering it's a longer term account, you want to kind of allocate a little at a time. I don't see a reason that you would have to wait. If you're looking at bonds and mutual funds and things like that, if you're going to start focusing on companies, let me find a way to say this that makes sense. So there's this massive capital rotation. And in 2022, there were companies that were doing really good, right? Because it was a part of that growth versus value dichotomy. Well, if we're going to rotate out of that and we're no longer going to be in this bearish market conditions, then all those names that were doing good, you got to kind of have the likelihood of they're going to start to not do good, right? And the names that weren't doing good are going to start doing good. So with that rotation going on, all of these trending names, AMC, AMD, right? Just look at where they're sitting, you know, near that 52-week high kind of thing. They're all in that upper quadrant, right? And these are the names that have been doing good through 2022 and were good, solid, long trends to the upside, which is the kind of stuff you want in your longer term, you know, portfolio. If we're going to see this capital rotation and start getting into our longer term hold accounts, we're very likely going to see this capital rotation through value and growth again. So all these that are doing good, they might start finally cycling out and not doing good, which means you're either going to have to be bottom fishing, picking up names like, say, Meta, PayPal, names that had that, Netflix, that had that really big drop down and are coming up off of the lows, because we're talking about that rotation, right? Coming back up and swapping out between value and growth. So I would just stress a little bit of caution on that. If it's just the indexes, like with the mutual funds, you can get into, like IBKR or Fidelity's small cap mutual fund or something like that, right? Then we're talking indexes at that point and sectors and some bonds. And that's pretty much what I've allocated into. A little bit of energy, some newer tech that isn't like the Microsoft, Apple kind of tech, but some newer tech, and mutual funds and bonds. That way you're at least starting to get in again, right? All right, we just set a new low on the morning. It really looks like we're going to expand beyond the weekly expected move at this point. It's going to begin the breakout. Remember that the algos won't really start buying in. Well, in this case, they won't start selling into this selling until we expand the second standard deviation. Right, so one standard deviation is not going to be the concern. It'll be one step beyond that, which means we have a long ways to fall if that's our concern. We're very likely not going to see that today. I always hesitate to say that because it seems like I say it and then, oh boy, there we go, and all right, finally, they have the market watch. I was looking for this earlier, but they had not posted it yet. Market wrap. BOJ nomination sparks sharp yen moves. Oil increased. Russia announced it will reduce output. Big move in the 2-year. So Bank of Japan is going to be getting new leadership, and there's not a lot of names on deck for who's going to replace the current leadership. The name that I had seen, and I'm not even going to try to pronounce any of these, the name that I had seen wasn't this guy. So now I'm going to have to go in and read a little bit more. The other guy was going to be, he was in the same camp of what we already had. Someone who firmly believed in yield control curve and was going to, kind of carry the torch of what they had been doing. My hunch is that this guy does not want to carry the torch and continue what they have been doing, which is going to be a global uproar if Japan stops doing what it has been doing when it comes to their policy. So a little bit of heads up on that. I'll catch some articles, see if I can dig a little deeper into this guy. These are the sharp moves that they're talking about in that article. We went from 131.50 down to 130 in a blink, and then back up to 131.50 and back down again. So quite an uproar. US dollar China, just run away. Right, see what's going on with the dollar. We've got a breakout now in play, looking for an inside day breakout from the previous day's high. It's not quite made the breakout yet, but it's challenging it. Now, a rising dollar like this, this is not an always thing, right? But in the current environment, what we've had for the last year, this rising dollar is going to be a weighted or pressure against the market. So we have an anticipation that the S&P and the NASDAQ will continue to go down as long as we're seeing this dollar continue to go up. Right now, it's not an inverse relationship like a teeter-totter. When one is going up, the other doesn't have to go down. But think of the dollar more as a weight that the S&P is carrying, right? It's holding it back, it's holding it down. And the longer you carry that weight, the heavier the weight feels, even if you really isn't getting any heavier. It just feels that way. So the more pressure that the dollar puts on the S&P nonstop, the more damage it's going to have. Right? We had a little bit of a relief on the fade back between 1 and 3, but that little bit of relief didn't last. We've already recaptured all of that and then some. It's something to keep in mind. And, notice across the board, we're not just looking at US dollar Japan. Sure, they're the ones rocking the boat, right? But it's not the only thing out there. And certainly not the only thing of concern to be aware of. Don't want to sit and stare at these all day, right? They're not going to provide triggers and insight like that, but try to be aware of what's going on in the FX space. We just passed through the 20-day moving average as well. So we're underneath all three of the major moving averages, 3, 10, and 20. I guess the 3 really isn't a major moving average. I shouldn't say that. But the 10 and the 20 are important, and we're underneath both of those. So critical levels, and now old support is now resistance. Look at the move in crude this morning. This will rock the boat. Absolutely 100%. This is also a liquidity gap. So the expectation is that crude will come back down and close the gap at 77.85. This is $1,000 per point, right? When you're trading the ES and it's $50 a point, and you're thinking, "Oh, yeah, man, it's kind of scary." Try oil. It's $1,000 a point. And talk about scary. That'll cause you to pucker up drinking your coffee in the morning. It looked like we were going to get some stability in Bitcoin. We're still looking for it to maintain above 21. 700 points. So, we're kind of moving a little bit closer there. And the VIX has woke up. You can see this steady climb to the upside in the VIX. We're getting back up. So we're looking at VIX above 21.5 and the dollar above 104. And that's going to be the two metrics. Let's try to run this like, I've heard the word swag. I kind of like it. It's not my word. And I don't want to like steal somebody's phrase, but let's try to do this in a way that gives us some benchmarks. So what would we need to see in the dollar and in the VIX for the S&P to make a new leg down? And what would that new leg down be? We're already below that 4,100. 4,000 is the next level. What would it take to get us below 4,000 with the VIX and the dollar? The idea would be the dollar above 105 and the VIX. I got the VIX futures up. Give me just a second. Swap those to regular VIX. It changes the numbers. I'd say the VIX above 25. So dollar 105, VIX 25. And we could very well see a break and a move below 4,000. Now, that's not perfect numbers, right? We're trying to gauge the impact from the dollar and the VIX and really try to kind of game out what it would take to break out of this box to the downside. Hmm. And 38 has more importance to me than that 4,000. At 4,000, we're still diddling in the middle, right? We're still in the middle of the range of that really big candle. 3,800, that's a whole new leg down. That's a real leg down. I'd say a definitive close above 25, not this wiki stuff where we got up there and then we came back down again, but a solid, legit close on the week above 25 and a continued move towards 30. I don't think we actually have to get through 30 to get above the ES below 3,800, but we got to be pushing towards it. Without that, breaking below 3,800, no. I don't see that. And the reason that becomes important is if you're trading the options on futures, which is a great way to approach kind of a more laid back trading style for those that work a day job. You can't babysit, markets. Whether or not we break below the 3,800 becomes a really critical thing. I've got some around that area. Of course, I'm still holding some from back here too. I could just close those out. So VIX weekly close above 25 with a continuation towards 30. And we could see a challenge of the 3,800 in the ES. Let's go take a look at the dollar, kind of game this out the same way. So definitely back above 105. There's absolutely no question on that one. But I think it would actually have to be more than that, especially with such a significant move off of the highs since October, right? And that was that Bank of Japan intervention, right? The October 21 collaboration with the Fed. It's not, it's not my analysis, right? That's not me talking. That's what I've heard from other analysts, right? When I talk about a lot of this, it comes from standing on the shoulders of giants. I read a lot of articles. Go back to that Twitter feed, that Twitter feed Discord that I built. Right, some of the greatest minds that I could find are in here. So I really think 105 wouldn't even be close, right? We'd have to start getting above this pivot point. So at least a move into 108 and perhaps even maybe a close above. I think asking for a close above is a bit much, but definitely getting above that 105 let's just call it 106. It's a solid round number, and it kind of splits the difference of what I'm looking for. So a significant close, solid close on the week above 106 with the VIX above 25 on the week. And we would be looking at the ES challenging that 3,800. Yeah, I run options on the futures. Well, I mean, I run options on everything, but I run options on the futures too. The reason for the futures is, well, money. If you wanted to sell a put on SPY, just a put, right? Not a put spread, you'll need, oh, rough estimate, $44,000 buying power reduction. And that's just for one put. If you wanted to do it on the SPX naked, just a naked put, you know, it's crazy numbers. But if you were to use the ES or the MES, the buying power reduction is much, much, much smaller. So for the MES, you're looking at $1,500, $1,800. And yeah, more than liquid for the ES. I don't get into the, the Russell, the NASDAQ, anything like that. And then how far out of the money you can go and still find money is awesome on the futures. So, carrying those 3,800 puts naked, when we were way up here, you're still getting a significant amount of money out of those things. So, kind of swing out here. Let's see. I normally use Tasty. Tasty does a better job of representing these. Well, whatever. We'll just hit this April one right here. So 3,800. Now you're not really getting that, right? You gotta run a multiplier. You take that number and you multiply it by whatever a point would make you. And for the ES, a point is $50. So you take 53.50 and multiply it by $50. The credit that you're going to collect would be $2,675. Now, since this is the ES and not the MES, your margin, your buying power reduction is around 18,000, but it's the ES, right? You do that on the MES and it's going to be like $1,800. And so you're able to look at a bigger picture like this and say, do you really think the ES is going to go to 4,600 this month, next month? And if the answer is no, then sell a call there, 4,600. You know what I mean? Like, just like that. Or do you think we're going to revisit 3,600? I mean, really, 3,600 in the next month? Nah, we're not going there in a month. Just sell a put there. So really broad, you can really get far away from price. Right now, there's more to it than this, because you better be able to defend it. Right? You got to either carry a hedge or have a defense plan, because if this thing comes at you and you started that trade out of the money, you're gonna freak out when the numbers start moving. So I've got videos that I've done, right, on different hedges. And I mean, a real simple solution is you could just buy you could buy an option. So if you sold a call and it explodes and starts running at you like a mad demon, and you're getting a margin call because the numbers are really freaking out, all you have to do is buy a call. Suddenly you're in a call spread. You're no longer in a naked call. You no longer need that massive margin call and buying power reduction. Sure, you had to fork out some cash, but it shuts down that margin call immediately, right? And you go from needing $30,000 in margin to whatever the difference is in the spread that you just bought, and solved, fixed, right? Something to be aware of. Don't trade in these things the same way that we trade in everything else. And most brokers won't let you in a spread roll a spread in futures. You're going to have to leg that roll apart, right? You got to break it apart and roll and then rebuild it. So it's just, there's some limitations. It's not as not the same as regular options. Mostly the same though. A $5,000 account can sell naked options on the MES. It's a rough number, right? It doesn't have to exactly be a $5,000 account, but you're going to need enough, to have some room, a little bit of room to wiggle. All right, so for the more minor trend that we've been dealing with here from the low, we got the swing high and the swing low. Kind of a line in the sand is this January 31st, kind of need to hold above that 4,000 level because we're just talking about higher highs and higher lows. We really don't want to set a lower low, right? We've been doing really good, kind of getting that trend going again, and setting a lower low shuts all of that down. Now, the line that I just snapped here is a regression line, and that gives us these bigger swings. That gets more into like least squared method, dot plot statistics, linear regression, and nerd out on you guys at 7 in the morning. But we've completed our swing over. We're on our way back down. Just keep in mind when we're coming back down to the linear line, it doesn't owe us a move through, right? It can get stopped and we can go right back up again. So just because we're coming down into that level doesn't necessarily we're going to make it through it. There's still a lot of signals I was looking at yesterday that suggest the current push up off of that January turn is not done yet. A lot of those metrics are just beginning to top out or roll over, but they haven't signaled the short trade yet. And that's more of the swing logic, right? Where we get a topping pattern and then a new leg and a big move. So, if you look at the scope and the size of these moves, there's plenty of room to wait. No reason to try to jump the gun early if you're looking for a good size swing, right? Not just, a 2 or 3 day move. These impulses are getting smaller and smaller. So really got to see how this plays out, right? This 4,200 rejection and the current pullback. Kind of the bigger picture thing, right? And it should be obvious that head and shoulders that ended up being shown there by the time I got done. We'll just leave that up there for right now. All right, the China K-Web constituents are down this morning, 2.5%, and emerging markets are down nearly 0.75%, not quite 1%. So a little bit of separation between those two. I'd like to get that cleaned up a little bit. Otherwise, we've got jets, semiconductors, all down this morning. And then for what is on the move, energy exploration, energy services, nat gas finally showing a little bit of green this morning. And a little bit in bonds. All right, 45% of the NASDAQ is down at least 0.5% this morning. That's a good chunk, including there's our China names, JD, PDD, Lucid, Lulu. So there's our China names this morning. Other mornings we had continued to look for those and they weren't showing up on the radar. They certainly aren't now. Only 33% of the S&P is down at least 0.5% this morning. So what that tells me is we need to take a look at the financials. But, as I was saying that, they are in here. There's Citi and Goldman, JP Morgan, Bank of America, Wells Fargo. They're in here. So usually when you see that big of a difference between the NASDAQ and the S&P, the difference comes from the fact that the NASDAQ doesn't have financials. And yet the financials are down this morning. So why are they not closer together? There's a sector difference here. Let's see if the heat map kind of points us in the right direction. All right, so some finance is down this morning, but there's still quite a bit that isn't. The FANGs certainly stand out. Hey, Walmart's up this morning. Right on. Google's not down very much looking at Google compared to its peers. I guess I'm just not seeing it. So look for these two to get in alignment together. This morning, when you're watching the tape, keep your eye on the indexes. What you can do is go to the top row, that'd be Market Watch. Second row, go to Visualize, choose Heat Map, and then get rid of it. Go to Index. From here, you can detach these things, right? So you kind of box it in, bring it up. Choose your watch list. There's the NASDAQ. And there's the S&P. You can pin them so they don't fall behind. I like to set that capital next to the issues, just kind of tighten everything up so we can make the box smaller. And you're going to be watching for a capital rotation this morning. And also be looking for the S&P and the NASDAQ to get on board and start moving in sync. So right now, one is down way more or less than the other one, right? We had 33% of the S&P and nearly 50% of the NASDAQ is down. So something's got to give. We want to see everything start to line up together, start to work in sync. And we're looking for a high correlation coefficient. That's just a big fancy word that says we want to see everything doing the same thing. Google really screwed up their AI event this week on the 7th, and they need to fix that. So for right now, what I'm already holding in Google, which I started out kind of small, I hadn't really built too much yet because they had not yet come out with the event when I started buying. I'm not buying anymore until they fix it. I mean, they've really, really screwed up this week. So they got to get that taken care of. Otherwise, I'm going to unload what I've already bought a little bit at a time and get out of it. They had an opportunity to dominate that space and really control the narrative, and instead they just completely screwed it all up. I'm completely 100% disappointed in their showing. Big picture in the long haul, we know that they're still going to dominate that space. It's going to be the difference that always has existed between Microsoft and Google, where one is more of an open source and the other one is a really locked down, strict, super security, kind of a tools and networking suite. So in the big picture, I think Google's going to get it together eventually, but that doesn't mean I'm going to blindly hold stock waiting for that to happen. They've got to, they got to fix it. A simple metric could be just as easy as seeing them get above that trend line. You know what I mean? Like, if they're going to rebase down here, and as long as they're holding these lows, then that's fine. But, you know, we just recently got in. So we're talking about, you know, an entry above $100 or around $100. That's not, there's no room there for error. So I'd rather get back out and look for an opportunity to get in along this lower trend line if they get that weak, or let them break over the trend line and prove it and get in somewhere else. They really, really screwed up. All right, guys, so that's what we want to look at today. High correlation coefficient. Avoid the chop, which is very likely what we could get, right? It could just be a really choppy, nasty day. And who needs that, right? We don't even need to kind of stress on that stuff. So let it prove itself, kind of flip things around. Oh, come on, Thinkorswim. Let everything start working together. Find that high correlation coefficient. And without it, we'll just go into the close. Very likely sideways on the week. And we'll start it all again next week. Without a lot of econ on deck today, it really is going to be speakers, right? Anybody out there chipping their teeth that happens to say something. And with CPI on deck next week, you have to really kind of approach this from the idea that why would any fund or firm go out and really start sizing up, knowing that CPI is just around the corner? It's on Tuesday, and that, if they're going to put hundreds of millions of dollars at work, they kind of need that data point first. All right, so everybody have a good day. Be careful, be safe, and see y'all next week.